Hi everyone, welcome to Emergence 2021. We're really excited to have you join us for the Family Office panel. And with our guest today, I'd like to start with introductions. So first of all, I'd like to introduce you to Meng Thoo from Leonie Hill Capital.
Hi everyone, good afternoon or good morning to you. I'm Meng from Singapore, and we are a MAS registered family office in Singapore. It's also a private equity and venture capital company. So we pride ourselves as a tech-driven family office investor. We've been investing extensively globally, primarily in the US, Japan, China, India, Asia, and into Europe. So quite widely spread into companies like Alibaba since year 2000, SpaceX, Tesla, Japanese robotics Fanuc, Olympus, and etc. Recent years, we've been investing a lot into highly disruptive companies into deep tech. So pretty much as all of us know, the disruptive force. So we have been very near to all these businesses, and we pretty much pride ourselves from really taking an entrepreneurial approach, investor approach, and also with the technology approach. Thank you.
Great, thank you. And then I'd like to have Mark De Ambrosis introduce himself. Mark is the Managing Director at Armitage Associates.
Thanks, Karen. So Armitage Associates, we're a Melbourne-based firm focusing on growth equity investments into small, medium-sized businesses here in Australia and New Zealand. We're really focused on investing in family-owned, privately held companies where a founder is still in the business. They're looking for growth capital or sell-down capital and an active partner to help them grow their business over time. And the reason we're probably relevant to this conversation is all of our investors are family offices. So we are very much family office capital for family-owned businesses, and look forward to talking about some of the trends we're seeing in that market.
And Roger Allen from Patagorang Investment Group. Can you share a few words on your background?
I started as a tech entrepreneur way back in the 70s. Built a deep tech software company starting in Australia, but went global. Went public in mid 80s, and when the company was acquired in the mid 90s, I set up the first early stage venture capital company in Australia. Set up an office in Silicon Valley. I split my time. I bought a place in San Francisco. I handed that over after 3 funds, but I continue to invest my own private money. So I have a venture capital portfolio of companies in the US, one in China, but I've had several in China and in Europe, as well as Australia and New Zealand. So I have a portfolio of about 40 odd companies in my private VC fund, as well as, of course, investments in public markets and real estate, etc. I've also created a foundation to focus on tackling social problems through venture capital principles, in particular helping Indigenous people, which is one of our biggest social problems in Australia, to start up their own businesses and grow them as a way out of the poverty trap and the like. So my focus is on social impact investing and in technology investing.
Great, thanks, Roger. And over to Patrick Harlalka, Investment Manager at Panthera Group.
Hi guys, hope everyone's good and there's not much echo now. So I'm from Panthera Group, and basically we are shopping centre owners where we own shopping centres across New South Wales, but we also invest heavily in technology, and we have our own funds management business for both property and technology which is mostly funded by the founders and family offices. So we deal with family offices quite a lot, and we are seeing a lot of trends in terms of investment from property to technology. And we actually have investments into other technologies too, while we also invest in our own technology, which facilitates better solutions for retail asset owners, and is specifically targeted towards retail asset owners. We still have the co-founders and principals of the company as the major funding source, and other smaller family offices who participate with us. Thank you.
Great. So I seem to hear that technology seems to be a recurring theme for all the family offices we have here, which is great. My first question relates to just how, in global recessions, such as more recently with COVID-19, how that has actually impacted your family office generally, and more specifically, what are you seeing in the Australian market?
Yeah. May I go?
Absolutely, Patrick.
Yeah, sure. So look, we have dealt with a few family offices who have had a very high level of focus on property, and very traditional property. And they have come into our fund quite early on and invested in retail property. But since then, we have actually created a solution which allows them to access more of the digital market and offer their retail solutions in a digital format, especially during COVID when people weren't physically able to come into the shopping centres. And there's been a significant level of interest in investing in the technology side of the business instead of the property. And more investors are getting sophisticated about technology. They're seeing the viability of companies like Uber and Menulog, who have done extremely well based on projections and have actually tracked through a lot of projections. So they are quite interested in working with startup companies and working with upcoming technology companies, and not just focusing on traditional asset classes.
And Roger, what are you seeing? Are you seeing sort of similar themes too, where?
Well, I'm always, my main investments are in technology companies. Most of them have actually done exceedingly well. Obviously, the ones that my actual biggest company by value is an e-commerce company in the payment space, so that has benefited a lot by what's happening with COVID. As we know, it's accelerated the trend to more and more online, etc. So I have a number of companies in the health space in the States, which were impacted in that in the medical area, there are a lot of face-to-face calls at hospital level, etc. We've turned that into a positive because I've been trying to lower the cost of customer acquisition anyway, and it's hard to get senior doctors, radiologists and others, away from having face-to-face calls. So we've used that to actually be able to significantly increase our online marketing and sales. The other big thing is the SaaS model, really holds up well, particularly in the enterprise space, because you've got recurring revenue. It's built in. It's built into the workflow, if you like, of the enterprise. So we've seen very low churn rates. Whereas more on the consumer SaaS side, people can cancel quite quickly. So the companies with good enterprise SaaS models have tended to not be impacted that much. There have been a few companies that are a bit more impacted than others, and some of my property companies have, where we've had to do some significant changes. But by and large, tech companies, have boomed really as a result of COVID.
Yeah, I think it's interesting hearing Roger speak. I mean, we at Armitage have about half of our companies as pure play software or software enabled business models. The other half are more real economy business models, and it has been interesting to see who have been the beneficiaries of COVID. And it's not to say that all of the real economy business models have been negatively affected. Quite the opposite. Some of those business models have actually seen tailwinds as a result of what's happened over the last 12 months. But it is fair to say that those digitally enabled, software enabled business models have absolutely come out of this period in much better shape. And I think, back to your original question, Karen, about family offices. I think we're not a family office. We obviously invest on behalf of a large number of family offices. I think the interest in technology was always high before COVID came along. I think this period has just reinforced that demand or interest, particularly from our investor base, in seeing what are those business models that have been beneficiaries of COVID over the last 12 months, and who are set up to continue to benefit from that once the world returns to whatever the new normal is.
And I think pretty much family office during this pandemic crisis, a lot of them actually had a toll on their portfolio, because primarily assets in the real economy space has been all hit hard. For instance, for us, although we've got quite a strong tech portfolio, we've got also a lot of those assets class sitting in the back, like aviation, oil and gas, and etc. So we during this trying times, what the team has put forward with is to really look at how to redeploy some of the capital, and pretty much we have been. As a result, we have been studying how the response to the pandemic. So because we are very tech savvy, we tend to now look at things a little bit different. So one of the things that we are trying to do internally is also to transform ourselves with digital. And we had put in quite a fair bit of money trying to bring in all the innovation and creating this transformation for the old business. Whereas for the new business, we are looking to create an impact that directly responds to the COVID. One instance is we invested into companies that has advanced diagnostic to accelerate health screening and border control, so that will help the government to accelerate, as well as to make sure that they've got a more secure border health screening point. So we have been deploying this in some of the emerging countries where the lack of the front line workers, lack of the training. So we need to do more automation, that making sure that the accuracy and the time clearance for each of those screening time, instead of just taking one swab, goes into nostril and start to dig and take about 15 minutes. We have been looking into some piloting technology to help accelerate those mission critical mission in the health screening space.
That's great, Wee Meng. And I think that is a good segue to my next question, which is actually how all of you, whether you're representing a family office or also investing on behalf of family offices, what sort of trends or different sort of areas of investment are you focused on now, just given the changes in the external environment? Clearly, there is a shift towards more digital tech-focused businesses. I might actually go back to you, Patrick, just given you deal with the real property space and you're trying to also digitize it. So I'd love to hear what you're investing in.
Yeah, thank you, Karen. Look, there's definitely been a very strong shift, especially due to COVID, for our investors to invest in technology that supports real property. So one of our own technologies is called RiverShop, which essentially allows any shopping centre owner to provide all of the services in a shopping centre to a digital trade area. And we have had a lot of interest in that particular investment category or that product over the past few years, but it significantly grew when 2020 hit, when COVID hit, and it was in real need by all retail asset owners. And we've seen a similar trend in other technologies that we are investing in on behalf of the investors as a fund manager. So we're investing in technologies which facilitate digitizing tables, so people don't need to go and queue up and essentially stand in lines with social distancing rules, but can order from their table in a shopping center as a digital table with a touch screen. And the interest in that significantly grew because it was still facilitating trade in shopping centers and helping people who are coming in see and do things easily or better. So going back to Ree's point, it is correct that the biggest thing that's going to lead to a higher investment in technology is things that will either automate or improve current things. And for us, from a retail property perspective during COVID, a lot of the technology that supports the physical shopping center has gotten a lot of support from the investors because it's got a very clear market space now. The demand for it is very clear now. So, yeah.
Right. And Mark, how about you? Are you more focused on certain types of industries or?
So our model probably hasn't changed too much as a result of COVID. Our focus is non-discretionary recurring revenue business models, about half of which end up being software business models, half of which are more real economy models. I think what I would say, as opposed to changing the way we think about those end markets and investing, what the last 12 months has done has probably reinforced a couple of things. The first thing it really reinforced is, we don't, as Armitage, we don't invest in discretionary consumer business models. I think that you'd need a period like this just to reinforce that model. So in that sense, I guess we've been fortunate. I think the other thing that has changed, is changing, and it'll be a question of how permanent this is on the software side. It's been interesting to see what has happened to valuation expectations in software businesses, particularly for an investor like Armitage, who are very much focused on cash flows and traditional profit metrics when we think about valuations, moving into a world where assets are trading more on valuation metrics linked to revenue, and it'd be interesting to see how sustained those changes in expectations are for a lot of these technology and software companies. And Roger, I'd be interested in what you're seeing in that regard on the VC front, because we've certainly seen pockets of the more traditional growth equity market that we've invested in, where you've seen step changes in valuation expectations, which we haven't necessarily participated in. I'm not sure if you're seeing the same kind of thing in the venture end of the market.
Yes, I'll come to that. My three themes that I particularly invest in is digital health. So health applications, but really driven by software. Some of that is embedded, but it's not new drugs as such, with all that implies. But there's a real macro trend of the IT and telecoms world, into the health sector. So I have a lot of investments in that space. One of them was a UK company, but one of the leading telehealth companies. And needless to say, its volumes went through the roof with COVID, and we actually listed that on the ASX in December. The second area is similar to it's enterprise SaaS companies, in particular in the fintech sector, and some emerging ones in the ag tech sector. And the third macro theme I invest in is all around cybersecurity, which itself is a broad category, but my most recent one is visual analytics, AI analysing from CCTV footage, etc. Yes, you're absolutely right. The supposed new norm is large multiples of ARR or recurring revenue. It's a little bit more. You have to be more discerning than that. It's really got to be high growth companies, recurring revenue, non-discretionary, as you put it, or built into workflows, high gross margins, high increasing ARPU, and low churn. If you put all those together, then obviously people extrapolate that eventually those companies will become or can become profitable. It's an open question as to whether this really is a bubble, and there comes a point if companies don't meet those metrics, if their growth rates fall off, etc., then they can be dealt with pretty severely, quite quickly, and come back to more, even still pretty high valuations, if you like. That of course flows down into the private market. So one of the problems is, even people in a very early stage company, they look at comparables in the public market and think, 10 times ARR, what they think they might do next year is, a good starting point. So it does put pressure on. You have to be very disciplined in investing and structuring investments correctly. I have either the advantage or disadvantage of having been through 4 major corrections since I listed my company in '87, just before the crash, then the major recession in the early '90s, the dot-com crash, and then the global financial crisis. So I've tried to impart some of those lessons to people who've only ever known it since the last 6 or 7 years, and try to position companies. Certainly one of the things with COVID was to really make sure your first priority was your current portfolio, make sure that they're okay. In a couple of cases, did some capital raisings just to make sure that even though you could think you could get through, you just never know how long these things are going to be, and you don't want to be trying to raise money when you're running out of money. So a lot of experience from having been through a lot of these issues. But there doesn't seem to be any slowing down or coming back to more fundamental PE type ratios. The clamour of the better companies, both in the private markets and in the public markets, is so strong. I mean, what we're talking about is obviously happening globally. The amount of investors wanting to rush. People were investing in tech before COVID. COVID has highlighted, a lot of these tech companies, e-commerce related, et cetera, et cetera. So it's, demand and supply for the better companies. They are commanding, really, really high valuations.
And definitely seeing that on the public markets where, a lot of the tech companies are, reaching all-time highs, on a daily, even weekly basis. So it's very exciting at the moment, but also we're seeing that trickle down to private valuations as well.
No, I wouldn't call it a trickle. I'd call it a flood.
Flood, yes. That's very true. Wee Meng, what are you seeing over in Singapore? Are you also seeing sort of the same sort of trend that we're seeing here and even more broadly in Asia with respect to valuations?
Well, definitely the valuation exercise has changed. I think we are seeing that there's a lot of the businesses in the cash crunch, and therefore I think they have to come to reality. And for us, we are looking into not just deploying a risk capital, but we must also look at how to transform the investment strategy. And because we are a single family office-backed fund, we are also constantly trying to bring the new generation of the FO members looking into investment. So we have switched from a profitable investment into a more responsible investment. So that's where I think the valuation, the case of valuation, in my view, for different asset class has to come into not just technology play, but also what has changed in this new world and how this whole mechanism of a business model works. For instance, we used to do a lot of tech investment. Now we get into infrastructure tech investment. So for infrastructure tech investment, right, of course, it's a longer horizon. But renewables, you don't just create an asset class of those solar as well as wind and hydro, but you look at the tech behind that would be able to mitigate the risk as well as to create that we call it the network sharing effect of grid. How do we create resilience in grid? So because we have invested in a lot of technology that requires infrastructure, for instance, Tesla. So we had also moved into some deep tech space where at the infrastructure level, how do we capture carbon effectively? So these are those technology that if you look at valuation, in the past, it has been very high valuation because of, the whole world is all talking about that. But now I think we've been seeing some new tech coming from Europe. I think people has been really getting more reasonable, where they think that they are able to give some little to strategic investor, and if we can take them to the next 3 years, whether into a new frontier or what, I'm not sure, but it's too long to gauge. But for now, we look at valuation more strategically as something reasonable, but that must be an impact where we can create from an infrastructure point of view.
If I may jump in, just very quickly, sorry, Karen. To the group in general, we spoke about valuations a fair bit, but how do you guys value data? Because that's the biggest X factor in most of these technology companies, where they're capturing vast amounts of live data like Uber and etc. And there is some sort of value that can be attached to the data they're capturing depending on how it can be used or how it can be used by the company or other companies. Do you guys take that into valuation when you look at a company?
I would tell you that virtually every company pitching tells you that they have this fantastic data and the like. When you really drill in how they're going to monetize it, most of them haven't got a clue. And so it is way, way overhyped. People talk about data lakes and the like. So you really have to understand how you will monetize that, and some of the IP and intellectual issues around it. We saw Google as an example do a whole thing on one of my companies does early detection of breast cancer, and they did this. They said, "Oh, we've got this AI. We're going to be doing breast cancer," and they never had proper patient permissions. They went to a health clinic and got this data, and the whole industry then just completely reacted dramatically because they didn't get proper, even though you might have anonymised data in some areas. But anyway, so a lot of people don't understand all the privacy issues and regulatory issues, and we know that landscape and regulations changing. It varies, between the European models and US. But I would tread very cautiously about people who claim they're going to monetize the data. I'd want to see some, real hard evidence of how they're going to do it or how they are doing it.
Yeah, I'd agree with that, and I think there's just different DNA in a business. There are certain businesses and entrepreneurs who built businesses around those kind of models. We're lucky to be investors in a company that IPO'd at the end of last year called Nuix, whose business model and reason for being is all about data and being able to take large volumes of unstructured data for e-discovery and investigations purposes, process that for the users of or the owners and the users of that data. That business and the DNA of that business is very different to other business models, particularly the real economy models, where they may have access to that information, as Roger said. Whether or not they can actually legally use it or not is one thing, but whether or not they've actually got the capability within their business to create a business model around that, I think is even more difficult a lot of the time. And it's something that we at Armitage in our business have actually gone so far as to invest in resources within our team to put into our portfolio companies, to enable them to work out how they can think about using and monetizing that information. But absolutely agree with Roger. I think that's very easy to say and very difficult to do.
Yeah, and Nuix I'm an investor in Nuix too, but that's really very different. That's data, that's data within police and security agencies and the like.
All right, great. I think we've spent a good amount of time just having a bit of chat as to the investment philosophies and trends of family offices. I'd like to spend a bit of time just on how family offices go about investing. So I thought I might just start with actually asking the group here if you're seeing an increase in co-investments amongst family offices. So I wonder if anyone wants to take that one.
Well, yeah, I can. It's because my whole background's in technology investing, so I've had a lot of family offices that typically haven't done much technology investing, referring things to me or wanting to co-invest and the like. So it is a learning curve for some family offices. And the like, but also some of the more successful tech, like the Atlassian guys, for instance, setting up their own funds. Typically, in most of these early stage companies, you've got 2, 3, even 4 VCs, whether it's family office VCs, direct your own money, or whether it's more institutional VCs. But that's pretty standard, and certainly family offices that don't have, they haven't got the full capability of a venture capital, professional venture capital firm, definitely like to invest together, and someone's going to do the heavy lifting, and of course there's the old, fear of missing out. I was looking at one where no one had made a decision, no one was committed. And I said, great, well, I'll take all of it, thanks. And they thought, we'll just do it.
Really good.
We don't want to upset these people. Some of them are, and of course everyone piles in. So quite often, if somebody takes the lead, then you'll find family offices that maybe not as experienced or don't have a team of people to do the due diligence or go on the board and all those things, will tend to want to jump in. And also a lot of the VCs that have raised money, have also offered co-investment rights. So you're seeing quite a lot of co-investment where they're piggybacking off VC funds, which they would have put money into the fund in order to get the co-investment rights. But that model is I've seen a lot of, I've done quite a few myself, co-investment deals.
Mm-hmm.
Yeah, so likewise here in Singapore, so we do have even the circles where it's organized by MAS, and we've got 40 over family office all coming together into this, we call it the FO circles. So we do deal flow sharing, and every quarter there's a big topic. Some of us, which is more tech savvy, will come out and talk about it and share it with our other peers. So, and we've got regular coffee and, basically just sharing some market intel. So after, I would say that it's not easy as during the beginning, but after a while, half a year later, you've got some friends turning mates, then people to start to come in together to do the co-investing. So we had some opportunities to do some co-investing. And also, like what Roger said, if you participate in any of the VC funds, typically they will structure those co-investing rights that will allow you to come in to club the deal for some deals that you like to. So it is happening. I'm seeing that more family offices in Asia are beginning to pick up this trend, because they are newer FO members, the new generation of people that most of them, the second generation's got some financial services background, and they are also some tech savvy. So they will come up more courageously to talk about it and put some of their fair share into those investments.
And Mark, what are you seeing? I mean, obviously, I think the family offices would look to you to help them, vet certain deals.
Investment
amongst families you work with.
Yeah, exactly. I mean, again, we're not a family office. I think, I'd agree with what Meng just said then in terms of, I think you're seeing a lot of the families that we deal with invest more internally in capability to be able to look at direct investment themselves, whether that's on their own and pursuing particular strategies. And it's interesting to see some of those strategies or alongside us in a co-investment capacity, as well as through us as a fund. I think, just as an aside to that, one of the things that we are seeing that's consistent with what Meng was saying before is having more conversations with investors about wanting to take a longer term view on certain assets that they are investing in. And so, when we started Armitage, one of our core philosophies was being able to take a longer term view with the capital, not looking to necessarily trade in and out of assets like a private equity fund, but being more family office like in so much as wanting to take a longer term view in the businesses that we partner with, that we invest in. And certainly what we've seen over the last 5 years is more and more family offices being more proactive in that approach and wanting to position themselves to be able to take longer term views in the businesses that they're invested in, whether it's through a fund vehicle like Armitage or whether it's directly in those assets that they're investing in themselves.
How about you, Patrick? What do you see?
Very, very likewise to what Roger and Mark said. Over the past few years, we've seen that there's a higher appetite for family offices to allocate funds to pre-IPO and even pre-revenue technology companies. But that is a caveat to the fund manager being us co-investing into those technology companies with them. So they do look at us for a little bit of direction when it comes to co-investment, going to your original question. But also there's been a higher appetite for them to invest in pre-IPO and pre-revenue companies where they are willing to take a long-term view on the investment and are willing to wait for the market to mature, the product to mature, to actually get profits and revenue coming back to them. So definitely it's been a stronger appetite for technology too from individual family offices.
I'd like to move on to my next question, which is how the family office approaches, the investment process and how that may compare to a VC fund. Maybe start with Roger, since you've probably got experience in both.
Well, it's a good question, and my answer is the same. And I had this company come to me, but the two key founders I knew quite well personally, and they came to me and said, we're just coming to you privately. We don't want to go to those VCs. This is after I was out of running my VC fund, but I was just with my own money. We don't want to go through all that stuff with VCs and all that term sheets and all that. I said, so you think when I invest my own money, I should invest it on terms that are not as favourable to me as when I invest other people's money? So I use absolutely standard VC terms for a start. In fact, I have a few of my own that a lot of VCs don't follow through and use properly, I don't think. I don't have, I often get this question because I have quite a large portfolio, but I don't have analysts and other people. What I have found over the years is you need your most experienced people to look at deals initially. And I think I've seen a lot of VCs make the mistake where new deals, the deal flow that comes in is looked at by, the junior analyst. It's very, very hard, obviously, to figure out, which company is going to be the most successful and the like. So to me, I'd like to look at everything initially myself first, and then I look, rather than have my own staff, I mean, I have, finance people and the like, but rather than have my own analysts in my network, I look for someone in my network. Pretty quickly I can find a domain expert, and I then do it that way. And rather than have sort of one person who's across everything, I look for, someone in the network. And if I need a particular deep dive on something, I'll use that person deal by deal. I've found that better. Or else, if I'm doing co-investment with someone else who's taking the lead, they will do a lot of the due diligence and other work. I will typically always have a look at it and suggest some things. But probably my network is probably the biggest asset. Within that network, you can really find people who can help a lot. The other thing I absolutely rely on is I ring up people in the industry, particularly customers. There's people, I'm looking at an ag tech thing at the moment. That's not my background, but a friend of mine's is going on the board, and he's raising money from, etc. So I'm looking at it, and so the people who really understand the technology and why they'd use it and how much they'd pay for it and all the rest of it. If they've got customers, I talk to the customers. If they don't have customers, I talk to the people who they think are going to be their customers. And I find you get a lot more from those people because they're out looking at everything that's on the market and the like. So I guess I take shortcuts from what what a lot of people do. I don't typically spend anywhere near as much time evaluating it or doing a lot of the typical due diligence. I've never found that necessarily. Obviously, I do some, but it doesn't. A lot of the most successful investments, there's a lot of judgment involved, and I'm talking companies that don't have balance sheets, don't have a lot of trading history. Obviously, there is you're really concerned about a number of things on IP and other things, but there's a lot. The earlier the company, the more it is about judgment.
Mm-hmm.
Yeah, I completely agree with that. And I used to work for a gentleman by the name of Mark Carnegie, who was prodigious at leveraging the network, which is something that we've absolutely replicated shamelessly in the Armitage business model for that reason. I think the other two things, that are absolutely not negotiable, at least for us, and I know the first would apply to everybody in this panel. First one is the founder. It's all about the founder, and that doesn't matter how good the deal is, doesn't matter how good the business model is. If the founder isn't right, that's just something you can't compromise on. Particularly if, like we do, you're taking a longer term view in the kind of businesses that you're you're investing in and partnering with. The other thing, though, that we spend a lot of time on that, isn't necessarily novel to Armitage, but it's something that, is a big function of our investment model is the first 100 days. And, even 30 days before we're cutting the check, we're investing on the first 100-day plan that really is critical to be able to set the business up to head in a particular direction, set the momentum and really align expectations for what that investment relationship is going to look like. So that's been, a big focus for every investment that we make. That's a core part of our model.
Mm-hmm.
Yeah, absolutely. I think the connection, the network is ultimately most important. I think for family offices, there may not be specialists that internally they are able to do enough due diligence. So we typically work with, the friends out there in the market that, it's not about the financial due diligence, in my opinion. It's more of, really you understand the business that in that operating environment. More important also the founder, right? And how would he be able to execute the vision? Is still a one-on-one thing, but because we are probably looking at them in the longer term, we want to make sure that if we can go in this stage, we can also inject into the subsequent stage. So it's about, working with him in the long term. It's about the journey. So a lot of the time that I spend is really onto the people factor.
Mm-hmm. And how about you, Patrick?
Definitely in line with what the rest of the panelists said. We found that working with VCs from all over the world, the key thing is the founder, the product, and the customer. So before we invest in any company, we want to know all of those three things, three people groups very well. And similar to a VC going in and investigating a completely new investment, we try to do the same thing. The only different approach that we have is we are very strategic about the investments we make, being in retail and property related, and in technology supporting the retail property. So we actually know our investments customers very well, and we ourselves are one of their customers in most cases. So it gives us a more in-depth view of the product and allows us to help them further. So from an investment perspective, we differ a little bit from VCs where they don't traditionally know the market or the product line that well, and we do. So that's the only place where we differ from VCs while investing as a fund manager.
Okay, that's great. I think, Patrick, this is actually my next question for the rest of the panelists is actually what can the family offices offer the investee companies that would make them want to take your capital over, say, a VC fund or another type of investor? So maybe I'll start with Mark.
Yeah, so happy to do that. When we're talking to when we're talking to an entrepreneur, we're really offering them three things: capital, our active team, and that network. And I always say the first one of those, the capital, is the commodity. It's the other two that really move the needle. And so being able to give them access to resources from our team to actually supplement their exec team to help them execute on a growth plan is really, really important. And then being able to give them access to a network who can open doors on the supplier side, the customer side, or just help them scale their business is a really, really big sales part of the sales pitch for us.
And how about you, Roger?
Exactly the same. I usually say the least important thing that I bring is the money. It really is. It's partly the network, obviously, to help, but it's also just the journey. For growing a company, going international. The founders or the team, building out the team, how to properly structure option plans, etc. The other thing I've been heavily involved in many, many companies is trying to reassure a customer that they're buying from a startup or early stage company. And quite often I have to get on a call and try to, convince them to take that risk of going with an early stage company and the like. And so quite often knowing, who's behind the company or who's helping them, who's not guaranteeing it, but, you're trying to give some confidence that, if they take a risk and buy from a young early stage company, there are some some people financially behind it, but also with some expertise and history and good governance on the board, etc.
And you, Wee Meng?
Well, I think the most important factor is about the joint business ownership. I think the family office money are really people from business owner as opposed to institution fund. So, and these are all successful business owners, successful entrepreneur. So we always like to impart that partnering spirit and the way how we look at things, the way how we can participate for joint success, while they still they still stir the boat and they are the captain of the ship, but we are all there behind trying to give our secret recipe away to them, helping them to not reinvent the wheel, but giving them ways that we think we have done it before and share with them openly so that they can also look at the success, that they can appreciate that we are part of their success.
Great. So we've actually sort of run out of time now. So I thought that was a great panel for us to understand sort of the investment trends that family offices are seeing, as well as also how they approach their investments. So thank you, Wee Meng. Thank you, Patrick, Mark, and Roger for your time today.